Welcome, visionaries and dreamers. Today, we're diving into a topic that can turn your dreams into reality. 7 ways to fund your business. Money is the lifeblood of any business, and how you acquire it can shape your entrepreneurial journey in unprecedented ways. It's not just about having capital, but about knowing the right places to look for it. We'll explore the array of options at your disposal, from the personal piggy bank to the golden gates of venture capital. We'll delve into the pros and cons, the ins and outs, the whens and whys of each funding method. Whether you're just starting out or looking to scale, understanding these funding avenues can be a game changer for your business. And remember, there's no one-size-fits-all solution. Your journey is unique. So if you're ready to learn about the financial avenues available to you, let's dive in. Starting with the first method, personal savings. Now, personal savings refers to the money you've stashed away over time. It could be from your salary, a previous business, or even an inheritance. It's your own money, and it's ready to be put to work. Using personal savings to fund your business can have its advantages. It's accessible, and you don't need to wait for approvals or deal with interest rates. Plus, there's a certain sense of pride in knowing that your business is self-funded. But it's not all roses. The primary drawback is the risk involved. If your business doesn't take off as expected, you could lose your hard-earned savings. And let's not forget the opportunity cost. The money you put into your business could have been invested elsewhere for potentially higher returns. It's a tough call, isn't it? But remember, it's not about being risk-averse or risk-loving. It's about being risk-aware. Understand the potential upsides and downsides before you decide to use your personal savings as a funding source. Also, it's important to keep a financial safety net. Don't pour all your savings into the business. Keep a portion aside for personal emergencies and unexpected business costs. Personal savings is a great place to start, but it's not the only option. Let's move on to the next method. Next up, we have friends and family. As we venture into the world of business, sometimes the first port of call for funding is a little closer to home than you might think. Yes, we're talking about friends and family. This method of funding is often overlooked, but it's a viable option, especially for those just starting out. When it comes to the pros, the obvious one is that your friends and family already know you and trust you. They believe in your vision, they want to see you succeed, and they're willing to invest in your dream. This method of funding also comes with fewer formalities and red tape, which can be a breath of fresh air in the often complex world of business financing. But let's not forget the cons. Mixing business with personal relationships can be a tricky path to navigate. It's crucial to be transparent about the risks involved and to set clear expectations from the start. If things don't go as planned, it could potentially strain these relationships. Another point to consider is that friends and family may not be as generous as other funding sources. They might not have the deep pockets of venture capitalists or the ability to provide large loans like banks. While it's a readily accessible option, it's important to remember the potential impact on relationships. Now, onto our third method. Our third funding method is bank loans. Now, this might sound a bit traditional, but hear me out. Bank loans are a widely recognized and utilized way to fund businesses. They can provide a substantial amount of capital, which can be especially useful for businesses that are in their growth phase. Here's how it works. Banks give you a lump sum of money that you pay back, with interest, over a predetermined period. Sounds simple, right? Well, there's a bit more to it. Banks usually require a comprehensive business plan, financial projections, and even some form of collateral. This could be real estate, equipment, or even inventory. Now, the advantages of bank loans are quite enticing. For one, you maintain complete control over your business. This isn't always the case with other forms of funding where you might have to give up a portion of your ownership. Also, interest on business loans is generally tax deductible, which can be a nice bonus at the end of the financial year. But as with everything in life, bank loans come with their fair share of disadvantages. The process can be time-consuming and the requirements stringent. Not to mention, the burden of repayment can weigh heavily, especially if your business hits a rough patch. Bank loans can be a viable option, but they do come with their own strings attached. Let's explore further. Method number 4 on our list is angel investors. These are individuals who have the capital and the interest to invest in businesses that they believe have significant growth potential. Unlike a loan, which needs to be repaid, angel investors provide funds in exchange for equity or ownership in your business. Attracting angel investors involves more than just having a great business idea. You'll need a solid business plan, a strong management team, and a clear path to profitability. Most importantly, You need to demonstrate that you can deliver a return on their investment. The advantage of funding your startup with angel investors is that they often bring more than just money to the table. Many of them are successful entrepreneurs themselves, and they can provide valuable mentorship and networking opportunities. On the flip side, raising capital from angel investors is not without its drawbacks. First, you'll have to give up a portion of your business ownership. This means you'll be sharing any future profits with your investors. Also, you may find yourself answering to your investors, which could limit your autonomy in running the business. Angel investors can provide significant funding and support, but it's important to remember they're looking for a return on their investment. Now, on to our fifth method. Next on our list, venture capital. Let's dive into this high-stakes world of investment. Venture capital, or VC, is a form of private equity financing that is provided by venture capital firms to startups and early-stage companies that have been deemed to have high growth potential. Unlike angel investors, who invest their own money, venture capitalists invest other people's money. But don't think it's easy money. Venture capitalists are known for their rigorous vetting processes. They're looking for businesses with a strong team, a unique value proposition, and a large market potential. Often, they want to see some traction or proof of concept before they invest. Now, the advantages of venture capital are substantial. It can provide the substantial funds needed to scale quickly and can also bring valuable expertise and contacts. Venture capitalists often provide more than just money. They provide mentorship, strategic guidance, and access to a network of potential partners, customers, and employees. However, there's a flip side. Venture capital isn't free money. In return for their investment, venture capitalists require equity in your company. This could mean losing some control over your business. And remember, they're looking for a return on their investment, often through an exit strategy like a sale or initial public offering. Venture capital can be a game changer, but it's not for everyone. Let's move on to the sixth method. Our sixth method is crowdfunding. Crowdfunding is a unique method of raising capital where you leverage the power of the crowd. Instead of seeking large sums from a few sources, crowdfunding flips the script and allows you to raise small amounts from a vast number of people. There are various platforms available for this, such as Kickstarter, Indiegogo, and GoFundMe. Each of these platforms has its unique features and benefits, so it's crucial to choose the one that best aligns with your business goals. One of the key advantages of crowdfunding is that it not only raises funds, but also creates a buzz around your business. It's like running a marketing campaign and a fundraising drive all in one go. Moreover, it allows your customers to feel part of your journey, fostering a sense of community and loyalty. However, it's not all roses. Crowdfunding requires a compelling story and a well-planned campaign to be successful. It can be time-consuming, and if your campaign fails to hit its target, it can potentially damage your brand's image. Plus, not all businesses are suitable for crowdfunding. Consumer-facing products with mass appeal often do better than niche or B2B products. But if done right, crowdfunding can be a great way to raise funds and create buzz around your business. Now let's move on to our final method. Last but not least, government grants and subsidies. These are a form of financial assistance that your business doesn't have to repay. Isn't that a breath of fresh air? They're like gifts from the government, but like any gift, there are strings attached. Government grants and subsidies are usually designed to stimulate economic growth or support certain industries. They can be a great source of capital for startups and small businesses in particular. But don't get too excited just yet. Obtaining these grants and subsidies can be a competitive and complex process. You'll need to meet specific criteria, which can range from your business's location, industry, to even the demographic of your team. The advantages of government grants and subsidies are clear. They provide funding that doesn't dilute your ownership, and there's no interest or need to repay. However, the disadvantages are also worth considering. The application process can be time-consuming and resource-intensive. The funds often come with conditions on how they can be used, and failing to meet these conditions could result in penalties. Despite these challenges, the potential benefits make government grants and subsidies an option worth exploring. If your business aligns with the government's strategic priorities, this could be a great way to fund your venture. Grants and subsidies can be a great boost, but they often come with specific criteria and conditions. So brace yourself for a bit of red tape. But remember, nothing ventured, nothing gained. And there you have it, 7 ways to fund your business. We've journeyed through the realms of personal savings, sought assistance from friends and family, explored the structured world of bank loans, courted angel investors, ventured into the high-stakes game of venture capital, rallied the masses with crowdfunding, and navigated the bureaucratic labyrinth of government grants and subsidies. Each method offers its own unique opportunities and challenges. The best fit depends on your specific needs, circumstances, and the nature of your business. Remember, it's about finding the right balance of risk and reward for you. It's your entrepreneurial journey, and every decision you make shapes the path you tread. Now tell us, which funding method are you considering for your business? Don't forget to like this video and subscribe to our channel for more informative content. Thanks for watching.